Hi, we are now on the fourth mini lecture for Chapter 2. This is on describing how costs flow through our accounting system into job order costing. So the last we spoke together, we were learning how to assign manufacturing overhead to the job cost sheets. So at this point, you've learned that our source documents, such as the materials requisition forms, cause the direct materials to get put onto the job cost sheet, that labor time tickets cause direct labor to be put onto the job cost sheets, and these are both direct materials and direct labor, which can be actually traced to that particular job. And then we learned in the last mini lecture that manufacturing overhead is an indirect cost and it can't be directly traced. So we need to somehow get that cost onto the job cost sheet because all three costs, direct materials, direct labor, and manufacturing overhead, have to become part of the cost of the product. So what we do is we calculate a predetermined overhead rate. We take the estimated total manufacturing overhead dollars and divide by the estimated allocation base or cost driver. And then we multiply that rate by the actual usage of the cost driver. And that could be direct labor hours, direct labor cost, or machine hours. And so those dollars are applied dollars. They are not actual overhead dollars. But this job cost sheet is not part of our general ledger accounts. We will be learning in this chapter how costs flow through our accounting system. So let me take a look here at our notes. Okay, there are three different types of inventory accounts in manufacturing systems. The first one is the raw materials inventory, and that represents the cost of materials purchased from suppliers but not yet used in production. So they remain in there until there is a materials requisition form ordering that they be moved from the raw materials inventory into the production process. So this account includes direct materials, which can be traced, as well as indirect materials. When that materials requisition form then requests materials into the production process, whether they are indirect or indirect, those materials get credited out of the inventory account and the raw materials inventory account, and get debited into the work in process inventory account. Remember, inventory is an asset, and assets and expenses both get increased on the debit side of the account, which is the left side, and credited to reduce those accounts. The credit side is the right side. So when material is purchased, it's debited to raw materials inventory and credited most likely to accounts payable. And then when materials are requested out, because there's production scheduled, we would credit to reduce the raw materials inventory and transfer those amounts by debiting work in process inventory. We'll be going over the journal entries in a moment. So the work in process inventory account will have in it the direct materials, the direct labor, and the applied work manufacturing overhead. Now, if you total up all the job cost sheets, they should equal that work in process inventory account. When jobs are finished, we move the amounts, the total of the job cost of the jobs, out of work in process inventory by crediting that account, and we debit finished goods inventory, which represents the costs of jobs that have been completed but not yet sold. When the jobs are sold, we credit finished goods inventory and debit the cost of goods sold. So as our notes indicate, the job cost sheets and the work in process inventory account sheets accumulate all three product costs: actual direct materials, actual direct labor and applied or allocated manufacturing overhead for each job. Let's take a look at the manufacturing overhead account here. This is just a temporary holding account. And on the debit side, we record actual manufacturing overhead. Actual manufacturing overhead costs are accumulated on the debit or left side of the manufacturing overhead account. So when we record depreciation, we would debit manufacturing overhead instead of debiting an expense account. And you would credit accumulated depreciation. As you are recording factory utilities or factory property taxes, you would debit the manufacturing overhead account, and you'd credit accounts payable or cash. So for every cost that is indirect in nature, we would debit manufacturing overhead instead of an expense account if it occurs in the factory. When it comes time to apply or allocate manufacturing overhead, we credit that manufacturing overhead account. Applied or allocated manufacturing overhead. To apply it to specific jobs based on the predetermined overhead rate, we credit the manufacturing overhead account. When a job is completed, its total is transferred to work in process and then into the finished goods inventory account. That amount, the total of the job that has been completed, is called the cost of goods manufactured. Again, once a job has been sold, we transfer it out of finished goods by crediting that asset account and debit the cost of goods sold account, which is an expense account on the income statement. Let's take a look at the flow of costs. Help make this a little bit more clear. Okay, so when raw materials inventory is purchased, we would debit the raw materials inventory account. And remember, that would be debited for both direct and indirect materials. When a materials requisition form is completed and materials are requested into the production process, actual materials get debited to work in process inventory. But indirect materials get debited to the left side of the manufacturing overhead account. Actual direct labor, based on time tickets, gets debited to work in process inventory. Indirect labor gets debited to the manufacturing overhead account. When it comes time to apply overhead to work in process inventory, we debit work in process inventory based on the predetermined overhead rate times the actual usage of the allocation base or cost driver, and we credit the overhead account. Once that job is completed, it's transferred to the finished goods inventory and sits there until sold, and then we credit finished goods inventory and debit the cost of goods sold. Now we take a look at some T accounts here, just to show you an idea of how this works. Remember that the left side of an account is the debit side, and for assets, we increase on the debit side. We decrease on the credit side. So all inventory accounts get increased on the debit side, decreased on the credit side. Manufacturing overhead will also get increased on the debit side and decreased on the credit side. So the cost of purchased raw materials is initially debited here to raw materials inventory and probably credited to accounts payable, because when materials are purchased, we don't usually pay for them in cash. The amount is just too great. When a materials requisition order is filled out and they are requested into the production process, we credit raw materials inventory and we debit direct materials to work in process inventory. We debit indirect materials to manufacturing overhead. And those amounts are posted onto the job sheets as well. So there are two places that are recording information about the production process. Job cost sheets will be recording information about specific jobs, and our accounting records are going to be recording the flow of costs through the accounting system. Now for direct labor. If labor can be traced to a specific job, if it is direct labor, then the cost is added to the job cost sheet and the work in process inventory account. And there's the direct labor in the work in process inventory account. We add by debiting. We also add that amount to the job cost sheet. If labor cannot be traced to a specific job, then the cost is considered indirect, and we will debit the manufacturing overhead account. How about applying that overhead? Manufacturing overhead is applied or debited to the work in process inventory account based on the predetermined overhead rate times the actual usage of the allocation base or cost driver. And there we go, 4,500 in total. It's split between 3,000 to job 27 and 1,500 to job 28. And we credit to remove that from the manufacturing overhead account. Now, while manufacturing overhead is being recorded for things that cannot be traced, we would be debiting to increase the manufacturing overhead account for things such as indirect materials, indirect labor, depreciation on factory equipment, property insurance on the factory, property taxes on the factory. Remember, all costs that occur in the factory have to be recorded in one of three areas as direct labor, direct materials, both of which can be traced, or factory overhead, which is indirect in nature, and so we have to apply it. So when actual costs occur, they are debited to manufacturing overhead, and when we apply overhead, we credit that account. Now you might be wondering, what accounts do we credit when we debit the overhead account? Well, it depends on what it is. If it's indirect materials, we'll be crediting the raw materials inventory account. If it's indirect labor, we'll probably be crediting wages payable or salaries payable. If it's depreciation, we'll be crediting the accumulated depreciation account. If it's property insurance, we will most likely be crediting prepaid property insurance. And property taxes, perhaps accounts payable, will be crediting. We'll be talking about those journal entries in a moment. Once those jobs are complete, we then transfer the total of the cost of the job into the finished goods inventory. The manufacturing cost on the job sheet of the completed job we call the cost of goods manufactured. It makes sense, right? That will be transferred from work in process inventory by crediting, because we credit to reduce assets, and then we debit that amount into the finished goods inventory because we increase assets by debiting. The finished goods inventory is equivalent to the merchandise inventory, or just plain inventory account that you learned about in Accounting 116. As the finished goods are sold, the cost of the goods sold will be transferred out of finished goods inventory by crediting to reduce the asset and debit the cost of goods sold, because that's how we increase expense accounts. Okay, now what about period costs? Well, period costs are immediately expensed as incurred in the period in which they're incurred. And that's what you're most familiar with from Accounting 116. For example, debiting advertising expense and crediting cash, debiting commissions expense and crediting a payable account or cash. Those are for period costs. Now, while we're here, let's take one more moment and let's talk about overapplied or underapplied manufacturing overhead. We said actual overhead costs are recorded on the debit or the left side of the manufacturing overhead account, and when we apply overhead, we credit that account. So any balance in the manufacturing overhead account represents the difference between the actual and applied overhead. And so we would call that amount either overapplied or underapplied overhead. And the reference point is the actual amount. In the best of all worlds, we would like to be able to accurately predict the amount of overhead and apply exactly what we should. However, remember your predetermined overhead rate is based on an estimate. If the overhead account has a credit balance, that means you applied more cost than actually occurred. Overhead was over-applied compared to the actual. What does that mean? You put too much cost onto that job. If the overhead account has a debit balance, it means the actual overhead costs were greater than the applied overhead costs. You underapplied your overhead as compared to the actual amount. You put too little cost on the job. Now this account, manufacturing overhead, we said was a temporary account. At the end of the accounting year, we have to dispose of the over or underapplied manufacturing overhead. So at the end of the year, the balance in the manufacturing overhead account needs to be eliminated, and most often it's transferred to the cost of goods sold account. And that's what we're going to do in this chapter. However, if you wanted to be super accurate, you would split the over or underapplied overhead between where that inventory now is. If it's still in work in process, a portion of it, you would put some of that under or overapplied overhead work in process. If it's waiting to be sold, you'd put some of it in the finished goods account. And if it's already sold, you would transfer some of that to the cost of goods sold. But what we're going to do is just close out the balance of the manufacturing overhead account into cost of goods sold. Since we didn't finish E2-18, let's finish it now because now we know enough to be able to complete this problem. This was the problem where we had to calculate the predetermined overhead rate, apply the overhead, and then calculate the actual manufacturing overhead costs. Remember we said that actual manufacturing overhead gets debited to the manufacturing overhead costs, or a manufacturing overhead account, and applied overhead gets credited to that account. If we then find the balance of the account, and remember the balance goes on the larger side, $25,300 minus $22,500 gives us a balance or a difference of $2,800, and that goes on the larger side. So have we over or under applied the overhead? Well, we have actual overhead of $25,300, and we have applied overhead of $22,500. So we have not applied enough. We have under applied our overhead. The actual is $25,300. We have applied too little, to the tune of $2,800. And that's it for this mini lecture.